Hey everyone, welcome. I'm glad you're here. I'm Conrad, Mazeika, a realtor living in Huntington Beach and a former financial planner, serving buyers and sellers across Orange County. So before I get into real estate, I spent years in financial planning. And honestly, that background is the reason I love doing shows like this one, because the gap between where, sorry, is there something moving?
Of some sort. Maybe it's
yeah, no worries. So before I got into financial planning, I spent years, and this is the gap where most people are financially and where they think that they need to be before they start buying a home, and it's a lot smaller than they think. So today I've got two incredible people joining me. Krystle, who is down in San Diego, and she's a military relocation specialist. And Sabina Adamski, who is our lender, and she's going to pull back the curtain on what actually happens when your file lands on an underwriter's desk. So here's what we're covering today: smart saving strategies, how to build and improve your credit, how lenders evaluate your finances, the mistake that delays people the most, and how to build a real timeline toward your first purchase. Whether you're 6 months out, a year out, or still in the dreaming stage, there's something for you here today. So drop your city in the chat and tell us where you're at and in the process. And keep your questions coming throughout the live stream. We'll get to them as many as we can towards the end. So let's get into it. So first part, smart saving strategies for future buyers. So let's cover real world savings tactics that go beyond just spend less. So we're talking about high yield savings accounts, automating transfers, keeping down payment funds separate, and building reserves through side income. So first question, what's the single biggest challenge you personally face with saving for a home? Is it income, expenses, or just not knowing where to start? What's been the typical go-to, Sabina?
Well, that's a great question, and I think it varies for different people. So while some people might have a pretty balanced financial profile, where the income looks great and the savings and assets look great and the credit looks great, sometimes we find that the biggest issue could be a deficiency in one of those, whether it's the amount saved. I'd say in our market in Southern California, it's usually going to be the savings and the down payment, unless you have, the blessing of having a gift from a family member or something like that. But when you really think about it, and let's just think of like $1 million home, just for starters, right? That might be $1 million home, and that might be a starter home for some people, or it could be a move-up home for others. But $1 million home, if you look at it with a 20% down, mentality, $200,000 is a lot of money. Plus closing costs, that's a lot of money to save. So that might feel a little bit overwhelming for a first-time home buyer. While 20% down is great, there are options to purchase with less down, sometimes 3.5% down, sometimes 5% down. But when you look at that compared to $1 million home purchase, that's also still a lot of money. So I'd say it's coming up with the down payment. That's the biggest, I think, challenge most people see, especially when you're trying to start young and start planning young. When you're in your 20s, that might be a little bit overwhelming. But knowing that the compound effect of your savings plus maybe the interest rate as well, like over time, you'll definitely get there. And then we also have those down payment assistance programs to help, or maybe, you know, negotiating a seller credit, which can help with the closing costs. But I'd say the biggest challenge is going to be development as far as where buyers, I think, are a little bit most overwhelmed.
Yeah. And I talk about it. I do have a YouTube video that, you know what, I'll put up in the description later, because, you know, you talk about, you know, your saving strategies in there. And what's really important is, you know, investing in the stock market. You know, what's your timeline? Is it, I'm going to buy a house, you know, this month or this year or in 5 years? And if you're going to put 100% of your savings in stock and want to buy, you know, this month, it's not a good time. Dow was at 50,000 and dropped to 46,000. So, you know, as you get closer to that, you know, saving to that, you know, time where like I'm pulling the trigger and this is what I'm going to do, you know, get it to something that's a little bit more safe, not safer, but less risky. Because as a former financial planner, it's nothing's safe as far as where you put your money, even in the bank. You know, there's still inflation risk if you put in the bank. So whether you put into bonds or, you know, high yield savings or savings account, it just, you know, kind of put that in that direction as you get to that step on there. You know,
I've definitely seen that mistake happen where someone had all their money still in their stocks and their funds, and you know, by the time their offer got accepted, the market dropped. And you know, I guess that's just another thing where it's like you can't really time the market in so many of the different markets. But I would think too, if you're planning on buying immediately, like in the next 2-3 months, I would probably start trying to move those funds out of those risky things, because as we've seen with even like recent you know, rate and market changes, is a lot of people, their stocks are down a little bit. So it would just really stink to open escrow now, knowing that you've lost some money, but then it's also like, well, you have that opportunity to open escrow now, which is a great
absolutely. Yeah, I did have a client, and he had a significant savings in crypto, and he was stressing, and the crypto market was starting to come down. He's like, oh, it's not as high as it was. I'm like, well, you got to get it out of crypto if this is for your down payment or for your closing costs. You know, sorry, don't screw around. You know, cut your losses and just, you know, do what you can. Which is more important, the getting the house today or waiting another year or two? Which, you know, 5%, you know, increase on $1 million property, that's, you know, $50,000 more. You know, can you come up with $50,000 in the next 11 months of savings?
That's the thing. I think people don't realize too is you're making money off of that full purchase price, right? It's you got to look at the long-term savings of that. It's like you just gain some equity, you know, within that year, and you really can't outsave or outpace home appreciation when you're looking at numbers like $50,000. Like we were just saying, like that's a lot of money to save.
Yeah, it's a good portion, you know, especially here in Southern California, and like one delay could cost you $10,000 pretty easily, even for like a month in some cases. So, okay, so Sabina, let's walk us through a realistic savings plan for someone earning $70,000 a year who wants to buy in 18 months.
I think it depends on 70,000 and they want to buy in 18 months.
Yeah, a year and a half.
Okay, so I'd say their ideal payment would probably be like $2,900, which, you know, might be like a $400. So give me 1 second.
Yeah, that's going to be a condo for sure.
I'd say trying to save about $900 to $1,000 a month is a good plan if they're starting from zero. Otherwise, you know, maybe less, maybe more. I'd say starting with that, whatever they can. I mean, I'm the type where it's nice to have a savings goal, right? And it's nice to meet that goal. But I'm the type where I'm like, well, let me cut out all the expenses and just try to save as much as I can so that I don't limit myself to $1,000 a month. So I'd say if you want to purchase in the next 18 months, a good plan would be to save every cent you can.
Have you guys?
And have your money in a high yield savings account at the very minimum. Don't have it sitting in just a regular checking account that's not earning any interest, and not just a regular savings account, from one of like the brick and mortar banks that is also not paying much in interest. I know a lot of big banks have like 1% or less, but then some of these online savings accounts paying, they're, at least 3.5% right now.
Krystle, you're about to say something?
Oh, that was literally it. I was going to say, have you guys seen, higher yielding accounts because, I'm approaching my 40s, and it was crazy that I didn't learn until my 30s that they exist and how important they are, and just different ways of vesting your money, if you will. And to your point, Sabina, you're both correct, actually, in the fact that people should be looking at the way that they're holding their investments, whether it's stocks, bonds, crypto, whatever, and look at liquidating it early or at an appropriate time for them, because like you said, they're markets and they shift. And when people wait, of course, that waiting can cost them. Happens all the time.
And one thing to note when looking at a high yield savings account is just checking to see if they allow wires, because I've definitely come across that where someone waited to move their money around. And so they ended up kind of not being able to send a wire on closing day because they didn't realize that the bank didn't send wires at all. And they had to do an ACH clearinghouse transaction to their other bank. And I know some people do that. And by some people, I mean me. I did that on my closing date. And I thought it was the most ironic thing, just as being a lender. And I know I told some of my lender friends, and they're like, Sabina, you know better. And I'm like, I know, I should have checked the wires and saw if that was even possible. And, it ended up being a mistake that was okay, just because everybody was willing to wait. But just making sure you check all the rules with sending a wire ahead of your closing date.
Including cutoff times. I've had issues where people were moving to the East Coast or from the East Coast, because it's happened to me a handful of times. And obviously with the time difference, and then you've got, multiple people involved. You've got escrow, you've got title. Everybody sort of has their own cutoff times. So I've definitely learned that it's critical to know when those are, just so that you don't have money in limbo and then panicked or stressed clients, or stressed anyone for that matter. It's happened to me twice where a wire was sent during the day, expected to be received same day. And because of those cutoffs and time differences and things like that, they weren't. So the overnight panic of like, where's the money?
Where's the money?
Not a fun experience.
It's in your account. And the escrow company and the title company doesn't have it. Where's the money?
It feels like it's just floating in limbo. And so like to call your clients and to have to counsel them through that overnight, just not my favorite experience, So yeah. Good, important things to know.
And it's just a little temporary discomfort. It's not unusual, I feel like, for buyers to be a little bit anxious throughout the process. It's such a big deal buying a home. So it's like, it's okay. You're going to be anxious. You're going to be nervous, but you're going to feel so much better as soon as you get those keys and it's all official, and you're going to be like, wow, I can't believe we're homeowners.
Yeah. It's a great feeling once you cross that finish line, right?
Absolutely. All the time. I mean, and then you have to realize too, if you do it the right way and you have a good tax person, you probably might get some, tax refund. So, not a tax advisor, but talk to your guy or gal.
Yeah. I tell people every single time in the beginning, whether it's a consult for buying, selling, investing, no matter what it is, I'm not the only professional that you're going to need. So like first thing out the gate and out of my mouth is make sure you're chatting with your tax professional, because the time of year, even simply just that, can affect things for people. So yeah, very important.
Absolutely. And it makes sense too, because, again, closer to April 15th, we have a lot more buyers that get into the pool because they get more comfortable. They have that conversation. It's good for the seller. There are more buyers there. So it's very important to talk to your tax, person, and talk to your attorney about, the title, whether it's, community property or trust, whatever the case may be. So what's a mistake you see often, Sabina, when a buyer finally gets their down payment together, then lose it before closing? Is there like
and they lose it before closing?
Yeah. Is there like some type of habits or experiences?
I'd say spending habits. Sometimes it's either one or the other, right? You're either in the mood of like saving, or you're in the mood of spending. So some people can be spenders, some people can be savers, and some people can go back and forth depending on the season of their life. I'd say, getting used to the dopamine hit of spending money and buying things can be detrimental, right? Because you get that little excitement, you get something new. Everybody likes to feel good and like a fresh new outfit and some new shoes, and that does feel good. But I'd say it's fleeting, and it doesn't feel as good as owning a home and having the security of not having to move. So I'd say, just getting into the habit of spending versus saving. Maybe buying a car, financing a car that's a little bit too overpriced. I think a lot of people make that mistake of financing a car that is really nice. Right? Like a super luxury vehicle, like those are great. Those are nice, right? But like not everybody needs a luxury vehicle, especially if they're not a homeowner yet, mainly because it usually holds people back, people who are trying to keep up with the Joneses. That's super detrimental. And I'm not even talking about even super luxury cars now. It's sometimes even like a nice brand new Toyota can run you like $65,000-$70,000, and financing that whole thing is probably like $1,300-$1,400 a month if you don't put some money down on it. So I'd say cars are the most detrimental thing people are doing right now.
Yeah, I think it's going to get more expensive with some of the tariffs that are going to come down the line with manufacturing. So I think we're going to see that pull buyers back a little bit. Yeah. So let's get into FICO conversation. So, if you could just break down what moves the needle on FICO scores, and like payment history, utilization, length of history, and what not to do before applying for a mortgage.
I'd say what not to do before applying for a mortgage would be don't have really high balances on your credit cards. At least from my experience, what I see impacts the score the most is if you have a $10,000 credit limit on a credit card, try not to have a balance of like 9,500 or something. I definitely try to keep the utilization under 30%. That's what I notice makes the biggest impact. So sometimes if people don't know, right, that sometimes maybe they do pay it off in full each month. They just don't know when it reports to the credit bureaus. Most of the time, your credit card will report to the credit bureaus at the close of your statement. Not when your payment is due, but it's usually at the close of the statement, usually when your balance is the highest. So if you are the type that pays it off in full each month anyway, I would just get in the habit of making payments weekly, right? And maybe not necessarily in full, but at least be making payments weekly so that when it does report to the credit bureaus, it's not at its absolute max capacity. So that's just one quick little hack. that works in boosting your score from sometimes 720 to 780, where it belongs, as long as you have, a good payment history and, the funds to do it. I'd say keeping those balances low in comparison to the credit limit is a great, tip for keeping that score high. And then not closing older accounts because, your age of your credit history is a factor of your score as well. So if you have an old card and it doesn't have an annual fee, I'd say leave it open and try to use it maybe once a year. Another thing is, on-time payments. That's the big one. That's probably more important than the credit limit and the balances. I just always assume that's a default, like don't miss a payment, but that's actually more important than the balances. And then outside of that, I'd say, I'm not sure. Am I missing anything?
Let me see.
I mean, I think you covered the majority of it. Yeah.
I'd say if you have maybe 12 credit inquiries within a year for a credit card, probably not a good look. That makes the credit bureaus feel like you're desperate for money. So try to keep those credit inquiries low before applying for a mortgage as well. And when I say applying for a mortgage, I mean once you're opening escrow, because at the pre-approval stage, it doesn't really matter, right? Because you have time to improve your credit and boost your credit. And there might be things you don't really know or understand prior to getting pre-approved. And if your timeline is 3 to 6 months, great. I'll just coach you on those quick little tips right before you open escrow.
Yeah. And that's an important point to bring out, that your mortgage opens up during escrow, which means don't be screwy with your credit during escrow. Don't buy a boat, don't buy a car, don't buy a tiger, don't buy, furniture, on credit. Just be savvy, during that period of time and suck it up. I mean, the biggest challenge that I had with a buyer was my brother. He was buying around Christmas time, and that's very challenging when there's credit cards floating around everywhere, and I got to get gifts for the family and gifts for the wife and all that other stuff. And so what I did was, I was sitting next to him on the speakerphone. I was like, can't do this. Got the lender on. He said, don't buy with credit. That's it.
That's it.
That's it. That's all he said. And he said, figure it out, just, cash or debit card, whatever, just not with credit, not right now.
Mm-hmm.
So yeah, that was the fastest lender conversation that he had.
Yeah. And then I'd say too, a lot of times I feel like people will hesitate to get pre-approved to purchase a home because they think they need to be perfect. They're like, you know what, I'm working on my credit. I'm going to work on paying off my student loans. And it's like, wait, actually that might not have as big of an impact as you think it would. And so people think that they need to be in the perfect situation at the time that they're getting pre-approved. And I try to let them know, you don't. We're going to help get you there. It's nice to see where you are in this point of time. And if you need to improve in any way, I'll let you know. I'll put together a plan for you. But that's no reason to necessarily not try to get pre-approved and at least know where you stand, because nobody's perfect and that's okay. I'm not perfect. You're not perfect. And we don't expect anybody to be. And it doesn't matter to me, if it's not perfect, I'm just here to help you and present options for you to, so that you can make the best, most educated decision that you can.
I mean, the answer to that question, actually, Sabina, is that, if you're considering buying a house and you want to have a good detailed plan, you call Sabina and say, what's the best plan for the best FICO out there for the best rate? Don't talk to mom and dad and brother and sister and the internet and ChatGPT. Talk to the person who's actually reviewing your stuff and can pull it up and have that conversation. So that's that's my bit.
And if the lender you're talking to, if it doesn't seem to make sense and you're not liking the vibe and you're not liking the way that things are being explained to you, that might just be the lender. Find another lender, ask your friends who they used. And, instead of like consulting people who maybe haven't done it in like 20 years or online in the internet or Reddit, I love Reddit. I'm a Redditor. And I'm on there and I'm commenting and I'm trying to give advice, but there's a lot of misinformation out there. And sometimes you can be led astray, right? Because a lot of like consumers out there, not everybody gets a mortgage all the time, and it's hard to know all the answers, and people only know what they know. But someone like a mortgage professional who's in it every day, and I do mortgages every day of my life, even on the weekends, there's a lot that you can learn from us. And if you're not getting that from your mortgage lender, it might just be your mortgage lender. There's nobody's saying that you can only work with one person and that person's word is the gospel. Check with others.
Yeah, absolutely. And
yeah, that's great for people to know. Like, surprise, so many people don't know that you can actually switch lenders during escrow. I had a scenario where we needed to do it. So
I had one that we did the other day. Absolutely. And we closed and they were very happy. And I left that door open for them. I was like, hey, if this bank, if what they're promising you ends up not being what they promised you, I'm going to leave all of this open and I'm not going to cancel the file out. Like, you let me know, I'll touch base with you. I'm like, don't be shy about it either, because I don't want you to get screwed over in this process. Like, it happens all the time. People do end up coming back, and literally we closed them on Tuesday, the end of the month. And they were just like, you were so calm about it. You kept saying, I'm not worried about the timeline. Like, whenever you're ready, like, don't worry about it. And then they're like, we closed on time and we didn't think we were going to be able to, by switching lenders 9 days before the closing. And I'm like, no worries, I'm not worried about it.
The answer, Sabina, is it's not my first rodeo.
Yeah, right. I'm like, I know
before.
how fast I can close a loan. So that's why I kept being like, I'm not worried about it.
Yeah, I know it's going to happen. Absolutely. All right. Okay, so what's the minimum credit score a buyer typically needs today? And what score range actually gets them the best rates?
The score that gets them the best rate on a conventional loan and a lot of portfolio loans is 780. Back in the day, probably like 5-6 years ago, it used to be 740 was considered perfect credit with no hits to the rate, or what we call loan level price adjustments in our world, LLPAs. As far as the lowest score to qualify for a mortgage, for an FHA and VA loan, typically about 580. 620 is even better. Conventional financing used to be 640. Now they got rid of minimum credit score requirements. But that doesn't necessarily mean that you'll get a mortgage, because we still have to put you through the automated underwriting system. And so even if you have a 600 score and Fannie Mae said that they'll do a loan and they have no minimum score requirements, your rate is probably going to be astronomical, and you might not get approved, because we run you through what we call desktop underwriter, or DU, or if it's a Freddie Mac loan, it'll be LP, loan prospector. And that system can be very finicky. So even if you check all the boxes and you meet all the requirements, that doesn't necessarily mean that the system will push it through, because the credit is a risk factor, right? And so it calculates the total risk factor, and it can be sometimes offset with a ton of money in reserves, a large down payment, lots of different things. But yeah, so minimum score, technically there is no minimum score anymore for conventional financing, but really you're going to want to be over 600.
That's good to know. Good to know. Now, if someone's at 620 today and wants to get to a 680 in 90 days, what are 2 or 3 moves that would matter most in that range?
So it depends on what's hurting their score. If it's just high balances on their in relation to their credit limits, then paying those down, right? Mm-hmm. And just starting with getting those all a little bit lower. I know that there's different methods, with the snowball method of paying off debt and the avalanche method. In this case, if you're trying to boost your score, I would try to level them all off low and drop them, because then your score will increase slowly. If it's due to some derogatory credit, and like collections, things like that, I'd say time. Time is the best thing, and just, making on-time payments and trying to improve your credit. But most of the time, if it's like 620 and you're trying to get to 680, usually it might have a couple of derogatories on the credit, which time helps, but then it's also in combination with maybe having high balances as well. So 90 days is definitely doable to improve credit.
Got it. Okay. So there's a lot of confusion about, credit card utilization. And I think you mentioned it earlier. So can you explain how it actually works in the ratio, what ratio buyers should be targeting again?
I'd say 30% or less.
Mm-hmm.
So if the credit limit is 10,000, just for easy math, 3,000.
3,000.
Yeah, I think once you start getting up, to like 50, 60%, you're going to see a pretty big impact on your score. But even more so if you get to like 9,000 on that $10,000 limit, or even like 9,900 or just maxed out, that's where you're going to see those big hits to your credit. But it does improve quickly. Like I'm the type where it just depends on where you are in relation to when you're purchasing a home and the timing of it. I love a 0% credit card. And I track everything. I have my Excel spreadsheets every month, so I know when that promotional period is going to be over. But I like it because, say I have a $10,000 balance on a, 0% card, and I have that $10,000 in a high yield savings account that's earning, 3.8% in interest. I prefer that because I'm a nerd and I love to play the interest game, and it's probably very negligible, but like I like it, and it makes me feel good to do that. But one time I saw a home that I really loved and I wanted to write an offer on it, and I wasn't pre-approved, but I'm a lender, so I kind of know where I would stand anyway. But when they ran my credit, I was like, 720. I'm like, but I want the best rate at 780. And I'm like, I'm an idiot. I have like a $10,000 balance on a $10,000 credit limit. And as soon as I paid that off, as soon as it reported to the credit bureaus again, it jumped up to like 800. And I was like, but timing, right? You just never know. And when you're not expecting to buy a house and you're not planning on it, and say you just closed on the house, doesn't matter as much what your credit score is if you're not planning on financing anything. But when you're buying a house, you do want to be a little bit more cognizant of it.
Yeah. I think, and you're right. It's just the timing, all of a sudden, we get calls, hey, I just saw this house and I need to start the process. Yeah. So just like, okay, are you pre-approved? And, 9 times out of 10, no, but I know my credit, and okay, just talk to the lender. Let's start there.
It's funny. We see it all the time, and it happens to us. Like we fall in love with something, we didn't think or plan on it, and it happens.
Yeah, I had, since we're getting close to Easter, I had a client a few years, it's almost 10 years ago. Yeah, he called me. He's like, I wasn't considering buying a house and keeping my condo where it's at, but my wife loves this house, and we've got to get this done. So, got to get pre-approved, and if your money's wrapped up in the house, you got to sell the house. So that's a decision on you. And
it happens, right? And it's okay because we can work quickly and we can pivot quickly, and ideally it is nice to plan these things ahead of time, because then you fall like in love with the home and you're not ready to purchase it, and then that kind of hurts. But sometimes that pain is the catalyst to being ready the next time something like that comes up.
That's
absolutely
so true.
When when the house of your dreams and the seller decides it's time for them to change their life and move out of it, whether it's by choice or relocation or death or divorce or bankruptcy, you got to that's what happens. You can't plan for that stuff from other people's outcomes.
Yeah, and you can't really, the wild thing about real estate is it's so dynamic and always changing. You know, like when I'm talking to some of my clients that might be getting discouraged because they're like, well, we're not seeing anything we like in our price point. I'm like, well, you know, next week's inventory can be completely different, and it likely will be. And it's so dynamic where I'm like, don't get discouraged. Don't stop looking, because like you might find something that fits most of your boxes. Maybe not all the boxes, but like nobody ever really finds something that checks all of the boxes. But like, you never know. Like inventory changes daily, and a lot of times we don't know what's coming on the market either, you know, and it's a surprise for us too. So you just never know what the mentality is of the seller, or how quickly they need to sell, or what's going on in their life too. But you can definitely still come across a deal here and there. I know everybody's looking for a deal.
Absolutely. So this question, what do you do if someone has almost no credit history at all, such as they've been paying cash for everything their whole life, and they decide they want to buy a house?
Go get yourself a credit card. That's number one. If they have no credit history, they can still get a credit card. They'll probably get something with like a $300 limit. If they have not good credit history instead of no credit history, that's, you know, a little bit different. They might need to get a secured credit card depending on what they're healing from. But no credit is, in my book, always better than bad credit. Mm-hmm. It's easier to start working on getting that score up. I'd say open that first credit card and then slowly start opening up other credit cards slowly, and start using them and paying them off each month. And I think that's a really good start.
Yeah. And or maybe weekly.
And actually one little hack is, if you have no credit history and you want to build some very quickly, open that first credit card. But if you have like a parent or somebody who's had a credit card open for a long time, like 20, 30 years, have them add you as an authorized user. And you don't even have to use it, but that will start reporting on your credit, and will definitely increase the credit history for you. As long as that credit card has a good history. Good history.
Good history.
You don't want to be added on a credit card that is, you know, went through some stuff.
Right.
Yeah. Great hack. Great idea. Great idea. Heard that before, and I think that's great. And like you said, the good history, not the tumultuous history. All right. I'm sorry, what was that, Krystle?
I always tell people no news is good news. So it's better to have no credit than bad credit.
That's what I say, always. It's easier to boost than bad credit, because bad credit sometimes just takes some time. Sometimes.
For sure.
All right. So, Sabina, if you could break down the term debt to income ratio for someone who's never heard the term, what does it actually mean for the buying power?
So debt to income, or DTI, as we like to call it, the mortgage industry loves acronyms. The DTI, debt to income ratio, is just how it sounds. It's your debts, your liabilities, your housing payment, your car payment, your student loan payment, your credit card payments, all divided by your income, your monthly gross income. In our world, in the mortgage world, we always use the gross income. That's before the taxes get taken out. So just because everybody's got varying, tax brackets and where they fall in with the tax deductions. So it's as simple as all of your debts and monthly payments divided by your income, and then your ideal debt to income ratio, probably be somewhere between 20 to 50%, just depending on what your life looks like.
Right. Great. Now, for someone who's self-employed or has variable income, what do lenders look for that's different than a W-2 employee?
Stability. So a variable income, typically depending on the variance of it, whether it's, an hourly employee who does not work 40 hours a week. Nurses, nurses, I'd say, are the biggest variable income that we see, and that's because of all the different differentials and the night shift and the day shift, and then the varying hours. Everybody, like a lot of nurses will have 312s or 410s, or just different shifts in their income. It's very rarely that they'll see like someone with 312-hour shifts. It's very rare that we'll see an exact 36 hours each week on each pay stub. It's very normal for us to see maybe 32 of this type of coding of pay, and then 5 of this coding of pay, and there's just a ton of overtime, big variance. So what we look at is a 2-year history, typically. Maybe 1 year if they recently changed jobs. If they did recently change jobs, we'll probably look at both jobs and see how everything looks. But what we're looking for is that the income is either stable or increasing. If it's decreasing, the underwriter does not necessarily like that without a reasonable explanation. With self-employed borrowers, I like to say that self-employed borrowers can sometimes be too good at finding the tax write-offs, and as they should be, right? You should write off all of your expenses, but sometimes that doesn't look as good in the mortgage world. So what the underwriter is looking for is just making sure that the income is a good reflection of what is to come. So we'll like to look at a 2-year history. If someone has been in business for at least 5 years, that they make an exception on the 2-year history, and they could use the most recently filed tax return, which is still in the past, right? So somebody applying for a mortgage today, if they haven't filed their 2025 taxes, we're looking at 2024, which might not be the best indication of their current income. So sometimes they might not be able to qualify for what they're looking to qualify for. So they can either quickly pivot to to filing their 2025 taxes, which is never fun because you have to gather so much documentation when you're self-employed to do so, or we can pivot and look at a business bank statement loan, because oftentimes if the tax returns are not showing the true picture, like, if it's from a year and a half ago and your income has increased tremendously in the last 12 months, we'll then collect 12 months of business bank statements and then use those deposit averages. And we'll figure a different expense ratio, and then we'll calculate your income for qualifying purposes.
Awesome. And the most important thing, again, is talk to your lender about your filings, tax filings, because I know that there's an advantage to using one or the other. But being that it's April 15th, you should probably get it done. But you do have until October for some of these extensions.
If you extend, because sometimes people don't extend, and then they're like, "Oh, I thought I had till October." I'm like, if you extend, now you're going to pay a penalty.
Yeah, absolutely. Okay. So what are lenders actually looking for when they comb through your bank statements? What flags a file immediately?
What I look for is large deposits, right? If somebody is depositing a large cash deposit, that might, and you can't source it, then that's something that we might not be able to use as assets towards the cash to close, and they could be short if they don't have money in other accounts, because we can back out a large deposit with an explanation and saying, that's cash, we can't really source it, but we're not using it towards the purchase. Then as long as they have other money and sufficient money, then that's fine. But that's what I look for typically. Now the underwriter, they're going to get a little bit more nitty gritty with it. And they love to call out like repeat transactions. So like a gym membership, they'll be like, can a borrower provide an explanation for what this is each month? And I'm like, it's very clearly a gym membership. And they're like, can they explain that? I go, yeah, they can explain that. And it's completely optional. And it's not a debt that you necessarily need to hit them with, but the underwriter is going to request an explanation. And, maybe like repeat Zelle transfers. I know I have one every month when I get my lashes done. I Zelle the girl who does my lashes, and I know the underwriter who did my one was like, "Oh, what is this a debt that you owe someone each month?" And I'm like, "Well, she does a service, an optional service for me that I choose to do each month. So yes." But yeah, the underwriter gets a little bit more nitty gritty. I look for the large deposits or anything that will be an issue. Something that the underwriter just needs an explanation for is it's not a big deal, right? So that just because the underwriter is asking for an explanation for something, that's just them making sure that they've covered all their bases, and that Fannie Mae and Freddie Mac, whoever the end investor is like, whoa, what is this gym membership?
Yeah. So on bank statements, I mean, this is a little bit off, the script, but has there been any questionable stuff that one spouse knows that the other spouse doesn't, that you've seen kind of blow up?
Likely not on the bank statements for a joint checking account, because that other spouse might
That's
already
obvious.
have access to it. What I've seen happen a handful of times, but definitely more than once, is where a spouse was not familiar with how much debt the other person had, because that is something that someone can kind of hide, right? So that happens more than you think. And usually it's a conversation I try to have first with the borrower who has the debt, just to,
Yeah.
So I'm not causing any problems by delivering the information to the other person yet. So usually that's a conversation I'll have with them first, and then kind of put it on them to tell the other person. Other times, if the other person's not really involved in the process and they're trying to and then like the other person just completely blindsided, and that happens, unfortunately. But usually they'll figure something out. They'll figure out a solution. I have not seen any relationships end because of it, because that is life. Right.
Yeah,
sometimes things happen, but that's the biggest surprise, is usually the credit card stuff. Bank statements, I would think if someone's doing something a little weird, that they're going to not do that with a joint checking account.
Yeah.
But I guess we're the ones who collect both, and then conditions go out. I have not seen that yet, but if I do, I will let you know. You'll be the first person.
Yeah. Just curious, I'm sure there's lots of stuff going. I mean, we're in Southern California, things get wild.
There's definitely times underwriters, maybe for a single person, and I have not seen anything come out for, a relationship where the partner finds anything else out. But like, I've definitely seen underwriters say things about like, can you explain what these OnlyFans transactions are? So that can be a surprise that the underwriter hits you with, but not in the sense where I've had two people on a loan where the underwriter asked something like that.
Yeah, it's getting interesting these days. Okay, talking about gifts, because you said you see these, large deposits come in. Can a buyer use a gift from the family for the down payment, and what are the rules about that?
Yes. Gifts are allowed on primary and second home purchases. As far as gifts on an investment property, if the loan is through Freddie Mac or Fannie Mae, the two biggest conforming and conventional mortgage holders, typically a gift is not allowed on investment properties, but then there are other programs that do allow investors to use gifts, and we use just a different investor for those kinds of programs. There's usually no stipulation as to how much of a gift someone can receive. So, all of it if you want. From family. It has to be an eligible gift donor.
Right. And that's from the gift tax exemption rules. Is that what you're following? So like, parents, siblings, grandparents, that's pretty much it, or is it close family?
Close family, close friends, family and close friends. So if it's a close friend, then the underwriter might ask for an explanation of how close of friends they are, just to see if there is a relationship there of some sort. That was a recent addition, like within recent years, where close friends are not allowed to give gifts as well. Your employer can give a gift. The property seller cannot. Your real estate agent cannot. So just certain little rules behind that. But as far as like the IRS rules and the tax rules, us lenders are not privy to any of that. We don't give any tax advice. I know that I usually tell people to check with their tax advisor, but I do know that the lifetime gift amount is quite large. I know the annual gift amount just needs to be typically reported, right? There's a special form that you fill out at tax time. But usually I will divert my clients to just double check with their tax person.
Yeah, absolutely. So what loan programs should first-time buyers know about right now? And is there anything out there that's a low or no down payment requirement?
Yeah, it depends on the program. So, the traditional mortgage that a first-time home buyer is going to get is going to be probably either a conventional Fannie Mae, Freddie Mac loan or a FHA loan. 0% down options are possible. Maybe they're looking at a down payment assistance program, which, they might still have to cover the closing costs or might have to come in with some money most of the time. And a lot of down payment assistance programs will provide maybe 3.5%, 5% down. There are some one-offs like the Cal HFA Dream for All program where they do 20% down payment assistance. Most of the time, it is money that you have to pay back. At least in California, most of the recent down payment assistance programs are all where you repay the money at some point when you sell the property or maybe when you refinance. Other down payment assistance, or not down payment assistance, but if you're putting 0% down, you might have that option when you're a veteran and you're using a VA loan, using your VA loan entitlement. Or if you're a physician, maybe you're going to use a special loan program, like a physician's loan program. So if you're, a dentist, a doctor, a veterinarian, anything like that, then you can take advantage of a physician's loan program as well with 0% down.
Yeah, those physician loan programs are great. And I actually did a whole video on it. So it's really good as far as you can close your house and then move in, before you start your job. So those are really impressive loans.
They're super cool.
Yeah,
and
it was one of my first deals that I ever did.
Doctors love them too. Imagine graduating from medical school, a huge accomplishment, getting a job and then just being able to buy a house right away. Like, how cool.
Yeah, amazing program. Okay, so I guess a question to all of us, and maybe Krystle can start with this. Have you seen, Krystle, a buyer when they're ready to close and something on the financial side derailed it? I mean, what have you seen something like that, Krystle or Sabina?
A couple times, yeah. I think that it just depends on what type of derailment that you're talking about, but it almost feels like during escrow, anything can happen, right? So it truly comes down to how you educate your clients and also how well you kind of know them and their habits and like what they might impulsively do. But I've definitely gotten 3 weeks into an escrow that was, I believe, 30 or 31 days for calendar's sake or closing sake. And we ended up completely falling out because they made a purchase that was something that, it truly threw everything off. It wasn't just one thing that was reversible or fixable. It absolutely changed their entire trajectory. And for a long period of time, I think that not only the escrow fell apart, but then life moving forward was a little bit tricky for them because they needed to realign things and kind of figure it out from there. So it's just really, I feel like, working with the right people and getting the right education. So having all the questions for your lender written down and really prepared, and just doing the right thing and educating yourself. And then for us on our end, not missing any of these key points, because it gets frustrating for a consumer if they feel like they haven't, they've gotten this far and everything's been on track and great, and then they just didn't know something, so different things. What about you, Sabina? What have you seen?
Everything. More than I wish I have. I've seen, I think I told you guys before one time, where the buyers, like dad went in and like demolished the place, and like that ended up, we only found out when the appraiser went out, so they had to fix that. But then the wife or the fiance, or she quit her job in the middle of the school year. She was a teacher, and we're just like, what? Then they had to get a co-signer. So we pivoted, right? There's a lot of times where you can pivot, but sometimes you just can't solve a problem. Like if someone goes out and just quits their job, right? Like that's a big one. I've seen people change jobs in the middle of escrow without knowing that in advance, but we've pivoted, right? We were like, okay, well, let's maybe extend the escrow slightly and then get the new, the offer letter and the new pay stub, as long as it's a very similar pay structure, salary to salary or even hourly to salary, then, sometimes you can pivot. What about you, Conrad?
No, nothing too, honestly, nothing too crazy, because I've, been upfront with my clients, because I've, heard conversations, I've been I just listened to other people's, drama about, not closing escrow over my career, that I've never had somebody derailed for finances. And I'm always like upfront, like, don't do this, don't do this, don't do this. You'll be fine. And I've never had anybody, like, because of, buying a car or boat or furniture or anything like that. I mean, the only time that I've had any like delays of escrow is just, my buyer didn't, he was still married to his ex, or he was separated, but, there was, not divorced when he was buying this house. So that was the only thing that kind of threw things off in my career. But I've always been upfront. I watch other realtors, and I know, like, start the conversation with buyers with, when you're in escrow, don't do these things, and follow the lender, call the lender on there.
That's right.
Okay. So, getting back to, you just mentioned the job situation. So is it safe to change jobs while you're under contract, or even in the middle of the loan process?
No, it is not safe to change jobs in the middle of escrow. I do not recommend it.
Yeah.
However, it's happened, and we've pivoted and we, made it work. But that's not always going to be the end result. That could completely derail your escrow. And if you've already removed all of your contingencies and you change jobs and you quit your job and we can't get you qualified using the new job, your earnest money that might not be protected then under that loan contingency if you've already lifted it.
Yeah. If it's if you put in $30,000 as your down payment or your deposit, bye.
Yeah.
Good.
And as far as changing jobs, like from the point of getting pre-approved to then getting opening escrow, just communicate with me. Let me know maybe before you even change the job. I tell my clients that too. If you plan on changing jobs, or you're going to be like looking for a job and you're like looking for a house within the next year or two, why don't you just keep me in the loop, have me run and review and ask me some questions, let me know what the new income structure is going to look like, and I'll let you know how that impacts your ability to qualify for what you're looking to qualify for.
And it's not just specifically jobs, because I know, like, with doctors, that are on W-2, sometimes they want a private practice in 1099. That's considered changing a job as well. And then going back to the self-employment, got to get that qualified. So, close the deal, buy the house, then get your private practice opened after you have the keys to the house. So
actually, that's a good point you bring up. With doctors, a lot of like hospital chains, maybe after 3 or 4 years, they give the doctor ownership percentage, and they become partner instead of, and it happens with attorneys too. Instead of a W-2 employee, they become partner, and instead now they're going to be earning their income through a K-1 from their ownership share of the hospital chain or the network, and that changes things. You just went from W-2 to self-employed, and so that definitely does change things. And usually people don't understand why that affects things, and I'm just like, well, it's a change in income structure. Now you're self-employed, so now there's just extra hoops or maybe even a waiting period for you.
Right. So, all the doctors that are watching this and listening to this, if this is clipped, hopefully, that changing that, to an ownership piece, you have to go through the process again. Okay. Should a buyer pay off old collections before applying, or can that actually hurt their score?
It depends on how old the collection is. I'm not a credit expert, but I do a lot of research on that kind of stuff. Sometimes a collection might be close to falling off, so I don't know if it necessarily would benefit them. Sometimes online they'll say, it can kind of like bring it up, and like now it's more of a recent thing. I think if you owe money and it's a collection, the way I look at it is pay it off, right?
Yeah.
If you can.
Absolutely. Okay. So, all right. So let's get into the comments. See what people have to ask. You may have answered some of these, so we'll go from there. Krystle looked like she had some technical issues. So let me see here. What am I looking at? Oh, okay. So tell us about the interest rates going on. So interest rates have been kind of bouncy in the last 4 weeks.
Bouncy is a good word to use. Bouncy is going to be the new word that I use, because I feel like I just keep saying volatile over and over and over again. And I like bouncy a little bit more. Yeah, they're bouncy. They went up a little bit. Rates react to geopolitical tensions and, just risks of inflation and recession. And so the market is very reactive, just like the stocks have been very bouncy as well. So rates are higher than they've been, maybe a month or two ago, but they're still lower than where they were sitting last year. So I still think that that's a win, of course. Would I like rates to kind of touch the fives again? Absolutely. And I think we'll get back there. I just don't know when. I feel like the rates have been bouncy for the last 4 years now, and it's starting to feel like the new normal. But when they're bouncy, it just means that they might continue to be a little bit bouncy. And so it's hard to time the market. If you have a reason to buy and you want to buy and you might get a good deal on buying a home, great, buy the home. Don't get too caught up on the interest rate, and refinance when rates bounce down for a second, and then they might bounce back up. But be ready. Work with a lender who looks out for those refinance opportunities for you, so that you're ready. You can act when the time presents itself.
I mean, I think the most important thing is that you're locking in the biggest expense on a monthly basis. When you buy a house. And, unless it's a super adjustable, rate, you kind of are controlling that budget, when you own that house. And then come down the line, let's say 6 months from now, interest rates drop to 5%, you get a good deal, hey, you save some money. So, and then other strategies, have the seller pay for a buy down. that's another way to go about it. There are properties that are sitting there, and maybe they'll work with that.
I'm with you.
Okay, so what debt to income ratio do I need to qualify?
It depends on the loan program. For qualifying purposes, Fannie Mae, Freddie Mac, we need to keep all your entire total debt to income ratio under 50%. If you're looking at an FHA loan, we need to get that housing ratio, and that just means that your housing payment in comparison to your income, including HOA dues, property taxes, insurance, your mortgage, we need to keep that under 47. FHA does allow us to go a little bit higher on the back end, including all debts into the 50s. And then we have some other loan programs that sometimes let us touch 55%. VA loans sometimes can go up to the 70s in the debt to income ratio. And that just, as long as they have a little bit of leftover and they meet the residual income requirements, which is money left over after taxes and after the expenses and depending on your family size. So I've seen VA loans hit the 70s, and that's not to say you should necessarily max it out like that. Nope. But everybody's situation is unique. Maybe it's just one person in a dual income family that's applying for the mortgage for whatever reason. So, I know people love to hate on someone maxing out their DTI online, but realistically, if there's only one person on the mortgage, but two people are actually contributing to the household income, that's just one of those scenarios. That doesn't tell the full story.
Yeah. All right, let me see here. This is a good question. What types of accounts should a future buyer actually be using to park their down payment savings? And
I think you and I both kind of touched on that, where it's depending on your timeline, right? If you're looking to immediately buy in the next immediate few months, probably a safer investment, like a savings account versus the stock market.
Yeah. Yeah, absolutely. The closer you get to that time frame, you don't want to be screwing around. And seriously, it's you're messing around with playing with fire, because the stock market does not align with the real estate market, and many cases, the real estate market could be the best performer of the year, and you don't want to be playing that game, because it never really it doesn't align all the time. Sometimes it does, but when it comes down, sometimes real estate will stay the same or go up. Let's see here. What if my FICO is 580? How long can it take to get to a 620?
Just depends on what's causing it to be 580.
Yeah, absolutely.
580 is, when you're under 600, it's unlikely that it's due to just one credit card with a high balance. It might be several, and so it might take some time for you to get out of that debt to improve the credit. So just depending on circumstances, if you come into a windfall of money, quite possibly immediately it goes up.
Yeah. All right. Is that Baymax behind Conrad? Yes, it is. So I've moved in, and so forgive the mess behind me and the boxes and all that other stuff. So I'm in the process of moving on there. Okay. So any final final comment on this whole conversation, Sabina?
I'd say I feel like every time we do this, I'm always talk to a lender earlier in the process. Even if you don't plan on buying this year, talk to a lender at some point. You don't have to necessarily, submit your application, but talk to a lender. Ask the questions that you're dying to know the answers to, and just wondering if you're on the right track, because it'll give you that peace of mind.
Absolutely. I mean, you're the expert in lending, and I always tell people just go to the expert on certain complicated matters. And buying a house is a complicated matter. You got to talk to the right people. Taxes are complicated. You have a tax person. Estate planning is complicated. Talk to an attorney. Just everything. It's not a simple question that you can rely on anybody on the internet to answer. So, thank you, Sabina, for joining us. And love to do this again. So that's a wrap on today's show. Generally one of my favorite conversations because this stuff matters. And if you're sitting on the fence about home ownership, I hope today made it feel a little more within reach, because most people, it really is. So if you want to talk specifically about your credit, savings, timeline, you can talk to me, you can talk to Sabina, and no pressure, no pitch, just a real conversation about where you are and what the path looks like. Huge thanks to Krystle and Sabina for being here today, two of the best in the business. So
thanks for having me.
Absolutely. If you got value out of this, please share this with someone who's been thinking about buying a home, and subscribe to the channel. Where's my thing? Where's my cool button? There it is. I'm getting old. So if you got value out of this, please share it with someone who's been thinking about buying a home, and subscribe to the channel so you don't miss out anything that's coming up. And drop a comment below. Tell us what topic you'd want us to cover next, and we'll see you on the next one.